Welcome back to the Global Business Report here on Arise News. I'm Idia Aisian, coming to you this morning from Nigeria's commercial capital, Lagos. Asia-Pacific leaders failed to agree on a communique at a summit in Papua New Guinea on Sunday for the first time in their history, as deep divisions between the United States and China over trade and investment stifled cooperation. Competition between the United States and China over the Pacific was also thrown into focus, with the U.S. and its Western allies launching a coordinated response to Beijing's Belt and Road program. Papua New Guinea Prime Minister Peter O'Neill said at a closing news conference when asked which of the 21 members of the Asia-Pacific Economic Cooperation Group could not agree, disclosed that there are two big giants in the room. O'Neill, who was chairman of the meeting, said the sticking point was over whether the mention of the World Trade Organization and its possible reform should be in the leaders' declaration. We cross to Hong Kong for the latest from Arise Asia business correspondent Flynn. Hi, Joel. So let's begin with Asian market action at the start of the week. What's been happening with regional trade today?
Well, good morning to you, Idia. Today was global uncertainties really about the trade war that were expected to dominate marketplace in the wake of this APEC summit drama. But in general, really, markets seem to have shrugged those concerns off. Certainly investors in China instead chose to focus on more accommodative policy measures which were announced by Beijing today. Shanghai's Composite index rose 0.9% today, led by gains in property and financial firms as a result. We saw the blue chip CSI 300 index add 1.1%. Meanwhile, the smaller Shenzhen Composite swung around from early losses to gain about 0.5% by the end of the session as well. Here in Hong Kong, shares also followed suit, tracking those mainland rises, which helped lift the benchmark Hang Seng here by 0.7%. While those real estate companies did see some fairly substantial gains offshore, underlying worries about Chinese demand dragged quite heavily on basic materials firms, concrete makers in particular here. In South Korea, meanwhile, investors appeared to be slightly more cautious as a result of the trade war concerns, but plays still pushed the Kospi up 0.4%, despite the won remaining flat for most of the session in Seoul. Japanese markets, though, eyed some fairly impressive export data out of Tokyo. Bargains on the Nikkei as well after that sell-off that we saw late last week, which lifted the index today 0.7%. Short position covering on chip-related stocks helped offset a drop in financials that had been hurt by lower US yields there. In Singapore, shares also fell, so too did Aussie equities. Traders down under, though, nervously eyeing US Fed tightening rather than these APEC trade war worries.
Well, how worrying is the failure to reach a consensus at APEC for markets, Joel, as well as for regional politics?
Well, I mean, this morning it did look like investors were rattled somewhat. By the end of the day, though, as I said, it felt like things really hadn't changed too much as far as the broader outlook. Investors had clearly found other things to pay closer attention to, as I said. But this lack of agreement at the APEC meeting in Papua New Guinea is clearly a significant concern. It does load more pressure, in particular, onto the G20 meeting later this month. At the heart of it, as you mentioned a moment ago in your intro, Idia, is this competition between the US and China, which I think it's fair to say is driving just about everything really in the global economy right now. And the sticking point between those two, at least this weekend, seems to be a paragraph that was focused on the World Trade Organization. But beyond that, it really looks like it is, as I said, competition. The Belt and Road issue, it clearly is at the heart of that. On Friday, we saw Chinese President Xi Jinping meeting with PNG officials. He was lauded, greeted with great fanfare indeed, just as he was pitching further Chinese investment in local infrastructure and opening a boulevard that had been paid for by that as well. So Western countries, led by the United States, are worried about the growing influence of these Belt and Road projects, not just in the South Pacific, of course, in places like Africa as well. And it does look like they are trying to try and coordinate a greater response to Belt and Road, which in diplomatic circles certainly seems to include outright criticism of China's broader conduct. There, of course, it's focused on this debt trap diplomacy. US VP Mike Pence yesterday said that China's Belt and Road investments were compromising sovereignty in some of these countries. Of course, Donald Trump wasn't at the APEC summit. He will be at Argentina, though, for this G20 meeting, as indeed will Xi Jinping. The two, as we know, are due to meet. The stakes, the tension, all of that doesn't look like it could be higher at the moment. So really, it does look like that could well be a boiling point for the next step in this trade war.
Well, Joel, clearly the criticism will continue to surround not just its conduct, but its motive. Well, reports today in China, meanwhile, Joel, that the government could be posed to allow more foreign control of Chinese joint ventures. How big a deal is that and why?
Well, I mean, on the diplomatic front, we're seeing one thing. At home, there's other things going on, of course. And this latest move by Beijing could be huge. Today, we heard Reuters reporting that China will be accepting applications early next year from foreign insurers who are looking to try and take control of their local joint ventures. Initially, that will mean a 51% stake instead of a 50% stake. But over a 3-year period, we could indeed see some of these foreign companies being permitted to take full ownership of their JVs, which was earlier than had previously been flagged. So this is according to sources who have direct knowledge of the deal, according to Reuters. You might remember last week we talked about possible concessions that China was making in this trade war. Chief among them was this foreign ownership of joint ventures in China. And so indeed it could be a big deal, I think, to answer your point. But frankly, there is some clamour inside of China for greater opening up, in particular in the corporate sector, thanks to concerns about the domestic economy. So I don't think we necessarily should see this solely as a trade war-related move. But the implications could still be pretty enormous, nonetheless, in particular as China looks to open up more broadly its financial sector. This, of course, is specifically about insurers. The insurance market in Greater China is the world's third largest. Do expect that to grow, though, if these foreign companies can indeed end up getting a bigger slice of the action.
Well, Joel, I guess we'll just have to wait and see. Now, on the earnings front, all eyes are on Hong Kong, presumably on Xiaomi, since its stock market debuted in the summer. And things don't seem to have gone really well for the Chinese smartphone maker in terms of its share price. Now, do we expect that to change?
Well, Xiaomi earnings are due this evening after the market closed, which was about just over an hour ago now. Xiaomi's a fairly big company in general. It's had a lot of focus on it in Hong Kong, in particular this year, as it IPO'd back in July. We discussed that here on this programme. But shares really since then are down more than 20% since then. And the firm, though, is still trading at multiples of its valuation, the PE multiples, at about the same scale as the tech behemoths of Tencent and Alibaba. Xiaomi is not quite on the same scale as those guys in terms of revenue, but the earnings are something that are being paid a lot of attention to as a result. The founder and director Lei Jun has described Xiaomi, which is a smartphone maker. He's described it as an innovation-driven internet company. But innovation-driven internet-related services only account for about 9% of Xiaomi's total revenue on average over the last 2 quarters. Smartphones, though, make up about 50%. And the key metric for Xiaomi really has been demand from emerging markets. Now, India has shown how valuable it is to Xiaomi's bottom line in Q2. That will be one big area that investors are watching. We know, for instance, that Xiaomi sold 11.7 million smartphones in the 3rd quarter, thanks to data out recently from IDC in India. That also showed market share was up, and year-on-year growth was about 27% in terms of handset sales for the company. So that bodes well today. The company itself, we know, has still pledged to keep its margins on those sales below 5%, though. Whether indeed that turns out to be a marketing ploy yet remains to be seen. So far, that is indeed what it is doing. But in order to continue to grow, it has to make sure that those sales numbers go up. Whether 20%, 27% or so across the board would be enough. Who's to say? Analysts indeed seem to be fairly encouraged at the moment. Today, we saw shares rise just under 5% ahead of these earnings, which, as I said, come out shortly. Once they do and they digest the bottom line, we will see how they trade tomorrow morning.
Well, thank you, Joel. Now let's finish with a quick look at the economy of Thailand. So it seems that in the third quarter, things aren't going very well for the tourism hotspot. Is that right?
Yeah, I'm happy to talk about this for myself. I was there only a couple of weeks ago on holiday. You might have noticed the tan, idiot. It seems I might be part of a shrinking number of tourists, though, heading to these Thai beaches for sun, sea and sand. If today's GDP numbers are anything to go by, they do show the economy stalling in the third quarter, weakness in those key growth drivers of exports and of tourism. Certainly in the spotlight. Seasonally adjusted growth for third quarter versus Q2 effectively was zero. That is significantly underperforming economists' expectations. All economists polled by Reuters had predicted that there would be marginal growth on the GDP front for an adjusted basis. But on an annualized basis, Q3 expansion was about 3.3%. But that could dampen further appetite. And this is the key point, really. At the central bank in Thailand, there's been a lot of calls for further rate tightening. It's a fairly hawkish policy environment, really, at the moment at the BOT and the government as well. And this broader view across the whole of 2018 may yet leave more space for that. But, as we know, as I was saying a moment ago, tourism will be key, and that hasn't been helped by some fairly high-profile accidents recently. Only this weekend, we saw a shipwreck being raised in Thailand of a boat that was sunk and resulted in the deaths of 47 Chinese visitors. Over the last third quarter, we saw the total number of Chinese tourists down 9%. So it'd be interesting to see how Thailand has to respond to that, whether it can indeed continue to drive GDP growth without further influxes of tourists. Indeed, that may prove beneficial to those of us that are still going to slightly emptier beaches.
Well, thank you, Joel, for joining me to discuss this today. Hopefully the situation in Thailand can pick up because I haven't visited yet. Arise Asia business correspondent there, Joel Flynn. You're watching the Global Business Report here on Arise News. It's time now for another short break.